What the heck is an FHA loan?
Hey, make sure you check us out at the realestateandchillpodcast.com. Buy your real estate merch now. Real estate merch with swag. A brand for hustlers only. Let's go!
Welcome back to the newest episode of Real Estate and Chill Podcast. I'm your host, James Chattery, mortgage lender, here for all your residential financial needs. Here with
Kevin Iglesias, associate real estate broker. Any real estate related questions, feel free to reach out to me right here. Either one of us.
Comment down below.
Yeah, true. Or
We'll hit it on the next video
slide in our DMs.
With questions about real estate.
Business, yes. Make that clear.
Yes.
Make that clear.
So, what are we talking about today, Kevin?
What the heck is an FHA loan?
I don't know. What is it?
You're the mortgage guy. Freaking asking you.
Yeah, I should know what this is. I do a lot of them. So, FHA loans is a government-backed loan that is primarily focused on helping first-time homebuyers.
All right. So it's a government-backed loan, right? And I would say in the market that we're in, depending on the towns, obviously, but what, like 90% of buyers are first-time home buyers, FHA approved?
Oh, I mean, I have no idea what the actual statistics are with what percentage of loans are FHA, but I would say probably 50% of my business is FHA business.
And that's a lot.
40 to 50% of it.
That's a lot.
I work with mostly first-time home buyers.
Right.
You work with a lot of first-time home buyers.
Right.
And we work on these deals together from, a lot of times. So, I would say that it's a very good benefit to people who are looking to get started in the home buying process. Down payment of a minimum of 3.5% down.
That's nothing.
You can roll your closing costs from up to 6% into the loan. Credit scores as low as like 580. It depends on what you get approved on. 580. If it's underneath that, you cannot get in with 3.5% down. It has to be 10% down.
Wow, that's a huge difference from 3.5% to 10% down.
Yeah, that's why I don't know exactly. It depends on your situation and what your credit looks like to see how low we can go below 580. But 580 and above, you could put down 3.5%.
I mean, look, I personally love FHA loans because it just helps so many buyers, especially first-time home buyers, gives them so much opportunity to become a homeowner.
Yeah.
Right? The American dream, as everybody would call it.
Yeah.
At little to no cost. I mean, think about it. If you're buying a property, let's just say $300,000, right? Put in 3.5% down, and you don't have to pay your closing costs. Like you were saying, you finance the closing costs into your mortgage.
Up to 6% of it.
Up to 6%, which is huge.
It should cover like most of it.
Most of it.
I'm saying most of it, but it should cover all of it.
I mean, there are out of pocket expenses that you have to pay for, like a home inspector, a survey, an attorney,
Appraisal.
an appraisal. I thought I said that. Survey, appraisal, home inspector, an attorney. So there are still expenses that you have to pay out of pocket, but they're not as significant as your closing cost.
Yeah, we're talking about a few $100s, like on these things. Attorney might be like $1,000 something.
Yeah, you're talking about a couple thousand.
You speak to, but those are like really the only out of pocket costs. And homeowners insurance, obviously, homeowners insurance premium you have to pay out of pocket
for the year.
For the year.
For the year, which people don't realize that either.
Yeah, so it's a premium for a year. So what you could be doing with an FHA loan is instead of waiting to have 20% down, it allows you to kind of, not have to save up as much money to get to that 20% down payment, and allows you to just get into the house right away. There are some setbacks, but let's talk about the positives first, right? The interest rates are a little bit lower than conventional. A lot of it depends on your situation, what your credit scores are, everything like that. There are, low down payment, full seller's concession, which is 6%, and then lower credit scores to qualify, better income requirements, looser income requirements, really, because the debt to income ratios can be higher. What is a debt to income ratio? So a debt to income ratio is the calculation we use to calculate your monthly payments compared to your income. So we can use higher numbers on FHA. So you can qualify for a higher loan amount through FHA in most cases.
All right. I mean, look, that all sounds good, but somebody listening like, that sounds too good to be true. You know why? Because we're about to get into the negatives.
Yes.
So the negative, I mean, I'll say it now, is that you'd have to pay PMI.
Yeah, that's the biggest negative.
And that doesn't go away, right, on the FHA loan.
So here's the thing about PMI. For FHA and conventional, it prices out different. So even on conventional loans, if you put down less than 20%, you have PMI.
Right, but up to what, 10 years?
It depends. So it depends on like the what do you call it? The credit score. It has to price out. So you get a custom quote for your PMI on conventional loans. We'll save that for another time though.
Hey, make sure you check us out at the realestateandchillpodcast.com. Buy your real estate merch now. Real estate merch with swag, a brand for hustlers only. Let's go.
Let's talk about FHA. FHA PMI is typically more expensive in some cases, but it stays for 30 years if you put down less than 10%. If you put down 10% on an FHA loan, what you could do is you can have PMI for the first 10 to 11 years, and then after that it goes away. But one thing that you would most likely want to do is refinance out of the FHA loan into a conventional loan when you build up enough equity in the house and you become in a better financial situation where you can afford it. So that's like one tip that I would have for you. Think of the FHA loan as like the starter loan, the loan that gets you into the house, right? That's the loan that you could use to get in. Once you're in the house, then you switch over to conventional if you would like. That's one way I would look at it.
Yeah, I mean, look, I used an FHA loan to purchase my first property, and I did exactly what you said. Finance the 6% closing costs and everything, and it worked out.
Yeah.
I mean, on the listing side, it's weird because most agents look down upon the FHA loans because they look at them as not as strong of a buyer compared to like conventional. But I mean, if you have a lender who's checked all your docs and make sure that everything is gonna work out, then
some of my quickest deals have been FHA. Literally. Like it's really not that different. I mean, like from my side of it, like getting the deal done, it's not that different. We're using a few calculations to find out if you can qualify for the loan or not. It's really not that different. The main difference I would say that we would probably see is the appraisals. FHA versus conventional appraisals. There are some differences in those. Nothing too different, but chipping paint. You want to look at like handrails.
Yeah, but these are, so when you're doing an appraisal, if you don't have any handrails, let's just say going down to the basement, they have to be installed, right? Chipping paint. So let's say the house has asbestos siding and there's chipping paint and you painted it over, whatever the case may be, that would have to be painted over. Any like safety hazards would definitely have to be taken care of. Shattered windows or things like that definitely has to be addressed.
Right.
And again, if you're trying to sell a property as is and the seller's like, look, I'm selling the property as is, these are things that if you accept an FHA deal, or that if you're looking to buy a home with its defects, that may be an obstacle that you may hit that would, potentially kill the deal. Because if the seller's like, look, I'm not willing to do anything,
then what can you do?
What can you do? Unless you do the work yourself.
And just pay for it out of pocket, but then you're paying for something that's not yours yet.
Right. So if the seller says, hey, look, I don't want to sell anymore, you basically just upgraded his house at your expense. Yeah. Right. So look, there's a risk with everything, right?
I've had people do that before, though.
I was going to say, look, there's a risk for everything, but if somebody truly wants something, they're going to do everything in their power to get it, right or wrong.
Correct.
I mean, and if you have somebody who's on the same page with you, like a seller who's like, look, I don't have any money, any funds, but you can do it at your expense and I'm still willing to sell you the house, I'm not going to screw you over, then why not? It'll work out.
So before we end off on this, I have one tip that you should most likely use if you're getting an FHA deal and if this applies to you. If you are getting an FHA loan, one thing to consider is you have to put down that 3.5%, right? And then if you have 6% set aside as well, what I would recommend is if you can get that number from 6% to like 7%, if you have that saved up, and you can put down 10% on the house and just get a full seller's concession to finance the closing costs, the way that it works is if you put down 10% and still get a full seller's concession, you still don't have to wait the whole 30 years to pay off that PMI. So that's a little trick. You can use the 3.5% plus the closing costs, whatever. Just use that money for closing. Instead of using it for closing, use it for the down payment and then get a seller's concession, for the closing costs and use that money and just roll that money into your loan. So therefore, you are not liable for 30 years of PMI.
That's a good tip. I mean, look, and everybody's situation is different. It's something that we have to talk about. Is if so-and-so is getting an FHA loan, but their credit is a little bit better than yours, you may not get the same terms as that person, right?
Right.
Your interest rate might be a little higher. Your mortgage payment, even if it's the same purchase price, let's just say, might be a little higher because you have a higher debt to ratio. You owe a lot more on credit cards, or have a car that you're leasing that's a huge monthly payment. There's so many factors that come into play that you can't compare your situation to somebody else's situation.
Yeah, you never should do that. On top of that, the main thing I see between two different properties, right, is always the taxes and everything. Like, you can never compare one house to another house, or, oh, somebody bought this house like a year ago and right now my mortgage payment is different. It is what it is. You can't compare like apples to oranges. Every single situation is different. But I think that there's going to be, a lot of questions on this one. So DM us if you have any questions. Let us know. We're here to help you with whatever you need. And with that being said, we're going to touch base on a few more of these topics in upcoming videos. So if you have any questions, leave them down below if you want it to be answered on the next episode of the show.
All right. So it's pretty much it. Wrapping it up.
All right. Well, that was the latest episode. We will see you next time.
Thank you for tuning in to the Real Estate and Chill podcast with James Chaudhry and Kevin Iglesias. Don't forget to like, comment, and subscribe. Also, share this with your friends, your enemies, your mother-in-law. No, seriously, this podcast is so fucking good, you might want to tell your ex. See you next time.